Has the Russia-Ukraine incident, the spike in oil and other commodities prices, and now this big rally in bonds that we're seeing in treasuries changed your opinion of the market or anything you're doing?
Well, it certainly, hi, Sarah. It certainly, and congratulations on the new show. It certainly has changed the way where we're buying. I mean, we've added to some names, and I can go over those in a minute. But I do think, I've been investing in, unfortunately, 7 out of the last 13 geopolitical crises. And, every single time the market ended up 12 months later, except for after 9/11. So we think there's a lot going right with the economy. I saw the Atlanta Fed numbers you referenced earlier as well. Now we're at 0% growth. But we're seeing a lot of really positive news, like growth in durable goods, CapEx spending significantly in the quarter or in the last month. And so we're taking advantage and picking our spots, trimming our winners and adding to some names that we've wanted to own or wanted to add to for a long time. So I think there's still opportunities for investors. I think in the second quarter, we'll all be breathing a sigh of relief, at least I hope so. But we added to L3 Harris a couple of weeks ago, or probably 3 weeks ago, in anticipation of improvements in the defense spending in this country, but also on geopolitical tensions.
Yeah, I mean, just on short-term basis, Sarah, in terms of the high blood pressure readings in the market is what I think has people a little bit uncomfortable. So you have the volatility index near 35. You've got this buying panic in treasuries. You've got oil, where it is for the wrong reasons. And to me, it's still just an excuse to kind of let's keep testing the low end of this range and see if those buyers, had conviction and are there. Where we stand right now in terms of the S&P 500, we're still, 150 points on the S&P above where we were on Thursday. So it's really difficult to draw any conclusions about what macro message is being sent, except for the fact that we're on edge because we're almost waiting for something to break loose with all this financial stress.
The macro message is so interesting because usually when you would see yields fall like this, you'd see the dollar fall, but it's the opposite. The dollar has been stronger. What's interesting is also European bonds. So when we talk about the fact that the market is taking out a lot of the hiking or the interest rate increases expected from the Fed, that's happening, but it's also happening in Europe where they just started talking about tightening. They're going to feel the impact of the Russian slowdown more than we are. Their banks, their companies' exposures, and their economic growth.
See, so
that's part of the Treasury trade as well.
They are going to feel it. The issue is it's indistinguishable right now from just a grab for safety and cash, as opposed to people handicapping what the economy is going to look like in a few months.
Because we're seeing that too. Gold's up, Japanese yen is up, all the safe havens.